I want you to imagine a scenario that is going to feel uncomfortable because it goes against everything you have been taught about money, investing, and success. Imagine you are standing on the deck of a massive ocean liner. It is the middle of the night, the air is freezing, and the ship has just hit an iceberg. You can hear the metal groaning. You can feel the deck tilting beneath your feet. Most of the passengers are still in the ballroom, drinking champagne, convinced that the ship is unsinkable because the captain told them so. But you know better. You have been watching the waterline rise. You have secured a spot on a lifeboat. You have your life jacket. You are safe. But then, just as you are about to lower the lifeboat into the water, a man runs up to you. He is wearing a tuxedo, he looks desperate, and he holds out a suitcase full of cash. He says, "I will give you $1 million for your seat in that lifeboat. Now, here is the question that defines your financial future. Do you take the money? In a normal world, $1 million is a fortune. It represents freedom, luxury, and security. But on a sinking ship, $1 million is just wet paper. It has zero utility. It cannot float. It cannot keep you warm. It cannot save you. If you trade your seat for that paper, you are making the worst trade of your life. You are trading survival for a symbol of value that has lost its meaning. This analogy is not hypothetical. This is the exact situation we are facing in the global financial system right now. The ship is the fiat currency system. The iceberg is the unpayable sovereign debt. The groaning metal is the bond market cracking under the pressure. And the lifeboat is your gold and silver. We are seeing prices push higher. Gold is moving toward numbers that used to sound like fantasy. Silver is waking up. And as you watch those green candles on the chart, a voice in your head is screaming at you. It is saying, "Sell, take the profit, lock it in, look at how many dollars you can get." That voice is the man in the tuxedo offering you the suitcase of cash. And today, I am going to explain why listening to that voice might be the single biggest mistake you ever make. We are going to answer the question, when should I sell, by completely dismantling the premise of the question itself. We are going to explore why selling your metals for currency during a monetary breakdown is a trap, and we are going to lay out the only exit strategy that actually makes sense: the strategy of ratio-based asset swapping. To understand why selling is the wrong framework, we have to look at what is happening to the engine of the global economy. For the last 80 years, we have lived in a world where the US dollar was the undisputed king. It was the measuring stick for everything else. Real estate, stocks, oil, gold, everything was priced in dollars. If the price went up, we assumed the asset became more valuable. But we are entering a new phase of history where the measuring stick itself is shrinking. The dollar is being debased at an accelerating rate to pay for debts that can never mathematically be repaid. When you see gold hitting new all-time highs, do not be fooled into thinking that gold is changing. Gold is a rock. It sits in a vault. It does nothing. It doesn't pay dividends. It doesn't invent new technology. It doesn't grow. An ounce of gold today is the exact same atomic structure as an ounce of gold in ancient Rome. It is the constant. So if the constant isn't changing, but the price is rising, what does that tell you? It tells you that the variable, the dollar, is collapsing. The rise in the price of gold is simply the reflection of the fall in the purchasing power of the currency. Therefore, if you sell your gold because the price looks high, what are you actually doing? You are trading a store of value that has preserved wealth for 5,000 years for a currency that is actively being destroyed by its own creators. You are jumping out of the lifeboat to grab the wet paper. This is the psychological trap of the profit taker in a hyperinflationary or stagflationary environment. You feel rich because you have more currency units, but you are actually poorer because you no longer own the asset that protects you from the system. We received a massive signal recently that confirms this thesis is not just for the tinfoil hat crowd anymore. A prominent billionaire hedge fund manager, someone who sits at the very top of the financial food chain, recently admitted in a public forum that the monetary order is breaking down. He didn't use coded language. He didn't sugarcoat it. He basically admitted that central banks are losing control of the bond market and that the only way out is to devalue the currency. When the insiders start telling you the system is broken, you need to listen. These are the people who have access to data that you and I will never see. They are positioning themselves accordingly. And what are they doing? They are buying gold. Central banks are buying gold at the fastest pace in history. They are not selling. They are not taking profits. They are accumulating. If the people who run the printing press are trading their own paper for metal, why on earth would you do the opposite? Let's dig deeper into the system signal. The bond market is the canary in the coal mine. Government bonds are supposed to be the risk-free asset. They are the collateral that underpins the entire banking system. But recently, we have seen volatility in the bond market that rivals meme stocks. Yields are spiking, then crashing, then spiking again. This is the sound of the foundation cracking. The debt is so large that the interest payments are consuming the entire budget. The government has to borrow more just to pay the interest. This creates a supply of bonds that the market cannot absorb. When there are no buyers for the debt, the central bank has to step in and print money to buy it. This is called yield curve control, or monetization of the debt. It is the end game for a fiat currency. It means the supply of money must expand exponentially to prevent a default. In this environment, holding gold and silver is not an investment. It is not a trade. It is an insurance policy against the insolvency of the counterparty. A dollar bill is a liability of the Federal Reserve. A bond is a liability of the Treasury. A bank deposit is a liability of the bank. If any of those institutions fail or if they choose to dilute their liability through inflation, you lose. Gold has no counterparty. It is not someone else's promise. It is the only financial asset that stands alone. It is sovereign. When the system is shaking, you want to own things that don't depend on the system working. You want assets that don't require a CEO, a politician, or a banker to do their job correctly. You want physics, not promises. So, if we agree that selling into fiat currency is a trap, does that mean you never sell? Are you supposed to just hoard metal in a safe until you die like a dragon sitting on a pile of treasure? No, that is also a mistake. Wealth is meant to be used. It is meant to improve your life, protect your family, and build a legacy. The goal is not to have the most metal. The goal is to have the most freedom and the most productive capacity. This brings us to the core strategy, the ratio trade. You do not sell your gold for dollars. You exchange your gold for other real assets. But you only do this when the ratio is historically extreme in your favor. This requires a shift in mindset. You have to stop thinking in terms of how many dollars is my gold worth? And start thinking in terms of how much house is my gold worth? How much land is my gold worth? How much of the Dow Jones Industrial Average is my gold worth? Let's look at the Dow to gold ratio. This is a classic indicator. It measures how many ounces of gold it takes to buy one share of the Dow Jones Index. At the peak of the stock market bubble in 1999, it took over 40 ounces of gold to buy the Dow. Stocks were expensive. Gold was cheap. If you had swapped stocks for gold then, you would have saved your fortune. By 2011, at the peak of the last precious metals bull market, the ratio fell to below 6. It took only 6 ounces of gold to buy the Dow. Stocks were cheap. Gold was expensive. If you had swapped your gold for high-quality dividend-paying stocks then, you would have ridden the next bull market up. We are approaching a time where this ratio could go to 1-to-1. History shows us that in a true monetary reset, the Dow and gold can meet at the same number. Imagine a world where the Dow is at 10,000 and gold is at $10,000 an ounce. 1 ounce buys the index. In that scenario, you would be swapping a static asset, gold, for the productive capacity of the greatest companies in America at a fire sale price. That is how generational wealth is created. You use the lifeboat to buy the wreckage of the ship after it is sunk and is being rebuilt. Let's apply this to real estate. This is the dream for many stackers. I want to buy a house with my silver. Right now, real estate is in a bubble fueled by cheap debt. Prices are at all-time highs relative to incomes. It takes hundreds of ounces of gold to buy a median home. But in a monetary breakdown, credit dries up. Banks stop lending. Interest rates skyrocket to fight inflation. When nobody can get a mortgage, house prices collapse in real terms. They might not collapse in dollar terms. The price might stay at $500,000. But because the dollar has collapsed, the price of gold has gone to $20,000. Suddenly, instead of needing 250 ounces of gold to buy a house, you might only need 25 ounces. This is the moment you wait for. You are not selling your gold. You are deploying it. You are capturing a mispricing in the market. You are trading an asset that has become overvalued, gold, for an asset that has become undervalued, real estate, due to the liquidity crisis. This is how the robber barons of the 19th century and the tycoons of the Great Depression made their fortunes. They held cash or gold when everyone else held debt, and they bought productive assets for pennies on the dollar when the credit cycle broke. This strategy requires immense patience. It requires you to sit on your hands while everyone else is getting rich in the casino. It requires you to ignore the FOMO, fear of missing out. When your friends are flipping houses or buying meme stocks, you are playing a different game. You are playing the long game. You are waiting for the fat pitch. And right now, the pitch is coming. The breakdown of the monetary system is the catalyst that will drive these ratios to extremes. Now, let's talk about silver. Silver is a different beast than gold. If gold is the stable lifeboat, silver is the speedboat. It is volatile. It is manic depressive. It crashes harder than gold, but it rips higher than gold. Silver is the people's money. It has a dual personality. It is a monetary metal, but it is also an industrial commodity essential for the modern world. Solar panels, electric vehicles, electronics, they all need silver. We are in a structural supply deficit. We are using more silver than we mine. Above-ground stockpiles are draining. When the monetary panic hits, silver will likely outperform gold in percentage terms. The gold-to-silver ratio, which currently sits near historically high levels, meaning silver is cheap relative to gold, will likely collapse. It could go to 30 to 1 or even 15 to 1. If that happens, your silver stack will have exploded in purchasing power. But holding silver is psychologically difficult. It will test you. You will see 10% drops in a day. You will see weeks of stagnation. This is why you need to compartmentalize your stack. I use a strategy called 2 buckets. Bucket 1 is your core position. This is your insurance. This is the metal you bury in the backyard or put in a private vault and forget about. You do not trade this. You do not touch this. This is for the worst case scenario. Total currency collapse, grid down, war. This metal is there to ensure that no matter what happens, you and your family can eat, you can bribe your way out of a bad situation, or you can start over. Bucket 2 is your tactical position. This is the metal you plan to use. This is the metal you are willing to exchange when the ratios get juicy. This is the metal you might swap for a rental property or a classic car or a piece of land or even a business. By mentally separating these 2 buckets, you relieve the pressure. You don't have to worry about timing the top with your whole stack. You know that your core position is safe forever. You are only playing with the tactical position. This allows you to think clearly. It prevents the panic selling that destroys so many investors. I want to address the uncomfortable truth that I mentioned at the beginning. The uncomfortable truth is that we are likely heading toward a period of lower standard of living for the West. The era of cheap goods, cheap energy, and cheap debt is over. The standard of living was artificially inflated by our ability to print the reserve currency. As that privilege erodes, reality sets in. In this environment, profit is not about making more dollars to buy more toys. Profit is about preserving your ability to function. It is about survival. Most people are going to get wiped out. I don't say that to be cruel, I say it because the math is undeniable. The vast majority of the population has zero savings, massive debt, and their entire financial life is tied to the stability of the dollar. When the dollar breaks, they break. They will be looking for a savior. They will be demanding government bailouts, stimulus checks, and price controls. And the government will give it to them, but the cost will be total dependence and hyperinflation. You, the person holding gold and silver, you are the remnant. You are the ones who stepped outside the matrix. You are the ones who looked at the emperor and saw he had no clothes. Because of this, you have a responsibility. Your wealth is not just for you, it is for your community. When the dust settles, society will need capital to rebuild. It will need people who have resources to start businesses, to employ people, to lend money, to fix things. That is you. You are the bank of the future. This is why you don't sell for a quick vacation. You don't sell to buy a new flat-screen TV. You are holding the seeds of the next economy. You don't eat your seed corn, you plant it. When you exchange your gold for a farm or a factory or an apartment building, you are planting that seed. You are taking the stored energy of your labor and converting it into productive capacity that will serve your children and grandchildren. Let's talk about the practical mechanics of the exit. How do you actually do it? Let's say gold goes to $10,000 and you want to buy a property. Do you go to a coin shop, sell the gold for cash, deposit the cash in the bank, and then write a check? Maybe. But that exposes you to the banking system, taxes, and scrutiny. In a high-friction environment, banks might freeze your account because a large deposit looks suspicious. They might implement capital controls. A better way, and a way that is becoming more common, is the direct asset swap. You find a seller who understands the situation. Maybe they are selling a piece of land. You offer them gold. You conduct the transaction in kind. This is how business has been done for thousands of years before the invention of central banks. It is private, it is efficient, and it creates a bond between buyer and seller. As the currency fails, more and more people will prefer payment in hard assets. We are already seeing this in countries with high inflation. You can buy a house in Turkey or Argentina with gold or dollars because nobody wants the local currency. That reality is coming to the West. You also need to watch the friction in the system. As the crisis accelerates, governments will try to trap capital. They might raise taxes on precious metals. They might implement windfall profit taxes. They might make it illegal to buy gold without a license. This is why having your metal in your possession is critical. If your gold is in an ETF or a vault in London or a bank safety deposit box, it is vulnerable. It is within the reach of the friction. Possession is 9/10 of the law. If you can't touch it, you don't own it. The timeline for this is not set in stone. It happens slowly, then all at once. We are in the slowly phase right now. The cracks are appearing, the bond market is twitching, the gold price is creeping up, but the all-at-once phase will be violent. It will happen over a weekend. A bank holiday will be declared. A currency devaluation will be announced on a Sunday night. When the markets open on Monday, the gap will be massive. You won't be able to get in. The doors will be shut. That is why you must be positioned now. You cannot wait for the confirmation. By the time it is obvious to the average person on the street, the opportunity is gone. The wealth transfer happens in the dark, before the dawn. So when do you sell? You sell when the hysteria reaches a fever pitch. You sell when your taxi driver is giving you stock tips about mining companies. You sell when there are lines around the block at the coin shop. You sell when the news anchors are wearing gold ties and talking about the new gold standard. That is the sign of the top of the panic cycle. That is when the ratio will be most favorable to you. That is when the crowd is desperate to get in, and you can gracefully step out into the assets that the crowd is dumping. Until then, you hold. You sit tight. You ignore the noise. You let the price fluctuate. You don't care if gold is down $50 today. You care that the system is mathematically doomed and you hold the only antidote. You are the captain of your own ship now. The ocean liner is sinking, but you are not on it. You are in the lifeboat and you have the supplies. Do not let the man in the tuxedo trick you into trading your safety for his worthless paper. Stay disciplined. Stay focused on the ratios. And remember, the goal is not to be the richest man in the graveyard. The goal is to be the architect of the new world. Your gold and silver are the tools. Use them wisely. The breakdown of the monetary system is not the end of the world. It is a reset. It is a cleansing fire. It burns away the debt, the malinvestment, and the illusions. What is left standing in the ashes is what is real. If you hold what is real, you will be the one who rebuilds. Keep stacking. Keep watching the bond market. Keep an eye on the ratios, and most importantly, keep your head when everyone else is losing theirs. The storm is here, but you are ready.